Thank you everyone for joining us today. As he said, this is Alternative Structures, PO Financing, Factoring, and MCAs. Thank you, and hopefully you've been here with us for all of the Business Borrowing Basic series, and this is the last episode 6 and episode 5. You can read more about financial poise on slide 61 and slides 7 through 10, also summarize the entire series, provides you a list of the Business Borrowing Basics. I have the pleasure today of being your moderator. My name is Jacqueline Brooks. I'm a partner with the Domain Morris LLP in our corporate practice group. And today I have the honor of being joined by 3 fantastic panelists. We have Harvey Gross, who is the founder and president of HSG Services and the executive director of the New York Institute of Credit. We have Jennifer Drafthorn, the Senior Vice President and Portfolio Manager of the Purchase Order Finance line of Rosenthal Capital Group. And we also have Michael Weiss, a corporate and commercial transaction partner with Weiss Burney LLC. So we do understand that you are here for the conversation and not for infomercials on us. But you can find information about each of the panelists as well as myself on slides 54 through 57. And speaking of the slides, so in this webinar, we will not step through the slides and we will not read the slides. But this webinar, like all Financial Poise webinars, will be a conversation. You should, however, keep the slide deck handy. As we go through our conversation, I will try to tell you the slide numbers that are referenced in our conversation. And it is also a great reference tool and issue spotting tool that you may need as you consider your financing needs. I'd like to recognize our co-producer, the National Law Review, and our sponsor for today's webinar, Max Asset. The National Law Review is a premier law news website offering in-depth analysis on a wide variety of legal and business topics. If you need to conduct an online auction, Max Asset is also your turnkey solution. You can find more information about National Law Review on slide 3, as well as Max Asset on slide 4. If you are attending this webinar during its live premiere today, you can submit questions using our portal. And if you're watching this webinar on demand, definitely feel free to send any questions that you have to info@financialpoise.com. Just include your question and the name of the webinar, and we will get you an answer as soon as possible. The steps for this are also on slide 51 if needed. So before we begin the program, I want to remind everyone that this conversation is meant for general informational purposes only, and not for you to act on without appropriate advice. So as slide 5 says, we are not your lawyers, accountants, bankers, or other advisors, and encourage you to consult with an attorney or other appropriate professional to determine what is in the best interest of your business and yourself as you make decisions. Now that we have gotten through all of the introductory items, let's dive into this conversation. So I often like in this series to talk through potential businesses, to go through all the things that businesses may deal with as they determine financing needs. For this one, let's talk about Marie, who is a thriving entrepreneur. She's a successful designer who has a design and manufacturing business for several years. She has benefit of having a lovely order from Saks Fifth Avenue, so her clothes must be quite luxurious, I guess. And Saks Fifth Avenue wants to purchase an entire fall clothing line, and is about to issue a $500,000 purchase order. Marie has some funds to fulfill the order, but all of the funds that she has will be used in order to fulfill the order, and she won't have any other cash. She can deliver the clothing line in about 60 days, but she will not be able to get paid on that order for 90 days. So during that period, she's trying to figure out how is she supposed to pay for employees, how she's to have other cash, assist with other cash flow needs. So Jennifer, what would be Marie's choice for financing in this situation?
So based on the scenario Jacqueline just described, if Marie were to enter into a factoring facility, she would not receive any funds from the factoring lender until the fall clothing line is produced and she's able to deliver and invoice it to Saks Fifth Avenue. Once the sales are invoiced, the factoring lender will advance against those invoices. But again, it doesn't give her any upfront cash. 150-day production to sales invoicing transaction cycle is long, and factoring does not help Marie with the cash flow during the goods production and in transit shipment cycle. Now, if she were to choose to look at an asset-based lending line of credit, most likely that would have to be secured by prior uncollected accounts receivable that she has on her books, inventory, equipment, intellectual property, things like that. Plus, the lender would be looking at the business history and if the business's credit rating is acceptable. If the prior uncollected AR inventory or other assets are available, the ABL lender can then look at lending a percentage of the value against these assets during the 150-day production cycle, where then would turn into sales invoicing, and she would have further eligibility and availability through the ABL line. The other thing to look at here would be a purchase order finance facility. It could be helpful to Marie in this scenario, and because instead of paying the $300,000 that Marie has on hand in cash to the supplier to produce the goods, the PO finance lender would advance those funds directly to the supplier, leaving Marie with the cash to work through her operating costs during that same production time period.
Okay.
Yes, the PO lender would not look to be paid back those amounts funded until after the sale of the fall line to Saks is completed and she's invoiced the $500,000. It's using that $500,000 in sales that the PO lender gets paid back.
And so it sounds like, so maybe a factoring arrangement is not what she needs here, because she needs the cash flow now. And it sounds like for an ABL, if she didn't have an existing relationship with a lender for an ABL, that might take a little time. So out of the options you've discussed, it sounds like maybe PO financing in this particular situation may be one of the better things for her.
It could be, yes.
Can you talk a little bit more about, so factoring, I know it's not something that everyone's heard about. So what exactly is a factor? If you could sort of explain that basic structure, that'd be great.
So factoring your accounts receivable invoicing is a financial transaction where a business sells its unpaid invoices to a third party, the factor, the lender. That sale is typically at a discount for immediate cash availability. So the factor will give you a certain percentage of availability off of those invoices pretty much immediately. A business can improve their cash flow by getting paid sooner than waiting for the sales customer to pay based on standard credit terms, 30, 60, 90, even now 120 days, we see. The factor then assumes the responsibility for collecting payment from the sales customer. This financing method can help a business avoid taking on traditional debt and assist the business in meeting priority financial obligations. At a basic level, an accounts receivable factoring transaction starts with the business delivering goods and submitting sales invoicing. The factor reviews, accepts, and then purchases those same receivables and advances 80 to 95% of the sales invoice value to the client within 1 to 3 business days.
Mhm.
The sales customer then pays based upon the terms, and the business gets the remainder of available funds, less paying less what the factor is owed for their fees and costs.
Okay. And so I would think getting a factoring arrangement would involve a number of diligence items and things that lender would need to look into as they're looking at those invoices. Michael, can you talk about or tell me, what would a lender look at from a due diligence standpoint or application process for a factoring arrangement?
Sure. And hopefully everybody can hear me okay. Yeah, a factoring application process is really akin to a loan application process. And in my experience, the factor will look at everything about the business. How's the company organized? Can I see your articles of organization or incorporation, your invoices, your history, your current clients, your billing process? Really, the whole write-up is in the application. What are your projections, your expected revenues, expenses, financial statements? It's in my experience and view, it's not that much easier than a loan. It's a good process for the reason Jennifer discussed, and we'll discuss more. But the application process is really still pretty extensive. In my experience, it's opening up your whole financial closet and your processes. And if you sort of stumble as the entity that's looking to factor your receivables in any of these parts, you may have a problem. It's not automatic. And I should add, a factor will do a lot of due diligence into your operations, your credit, your experience, whether you filed bankruptcy, who your customer base is, what are your collections history, what is your billing process, background check on you. So it's a lot of work. It doesn't happen overnight.
Yeah, I know we have in a slide deck on slides 21 through 22 some of the things to look at. So it does sound very similar as far as some of the due diligence as an ABL that we've talked about earlier in the series. Harvey, is it cheaper or more expensive to do like a factoring arrangement versus a conventional sort of ABL?
So that's a great question that's been asked for many years. If you're going to look into factoring, it's not just the cost, but the value of what the factor brings. And many times you could save internal expenses by using your factor by outsourcing certain things such as collections and other type of operational assistance. But in addition to that, it's a way of getting money at a reasonable price because factors do charge a fee, and they do have two types of fees. One is the actual giving up the money and charging for the money, and the other is the bookkeeping services and collections, which Jennifer pointed out. So there are two phases to that, and it's important to know that. And she touched on the value. Many times when you're in the business, especially in the apparel business, many factors have been brought up in the apparel industry over the decades, and they have a good idea as to the industry and who the good customers are and the bad customers. And they could give you a lot of guidance. And I know you have later on in your program, you're going to talk about recourse and non-recourse. So I'm going to add it now just to show you the extra advantage by being with a factor, in addition to getting the money. And you're, as Jennifer pointed out and Michael pointed out, you're getting your money like a loan, but it's a purchase of a receivable. You're actually getting the risk covered if you get and fortunate enough to get into what's called a non-recourse arrangement. That means the factor buys the risk, guarantees the ability of the customer to pay, and unless there's a dispute, the factor's on the hook if anything happens. And in the old days, many manufacturers felt, well, I know Macy's and I know this one and that one, so I don't need protection. But we found out over the years, the hard way, you really do need the protection, especially after all the different issues that have happened with leverage buyouts and COVID, etc. So that being said, the factor serves the purpose not just for the money, can give guidance. If it's a non-recourse arrangement, you're outsourcing the risk. That's very important. And that factor also can give you an idea in the marketplace whether you are competing with others and how you're doing. And they usually see things well before others. And that's why they're almost like a consulting source. I can't say enough about the value that factor could bring. Even on a recourse basis, where the factor doesn't buy the risk on the receivable, they just fund the receivable. Many times they're going to give you guidance whether that's a good receivable or not by the way they're going to want to purchase against it. Meaning, if it's a better customer, they'll give you a higher advance rate against it. And if it's not, they'll give you a lower advance arrangement. So even though it's a recourse basis, you'll get value to knowing a little more about the strength of your customer.
And so let's dive more into what recourse and non-recourse actually means. What do they have recourse against? Jennifer, can you explain a little bit more about that?
Sure. So factoring with or without recourse differs in who bears the risk of non-payment on those factored invoices. In a non-recourse factoring facility, the factoring lender assumes the risk of non-payment, meaning the lender could lose money if a sales customer doesn't pay. In a recourse factoring facility, the business selling the invoices is responsible for buying back unpaid invoices from the factoring lender. With recourse factoring, the business assumes more of the risk associated with the sales customer non-payment. When utilizing a recourse facility, many factoring lenders look to the client, the business, to carry credit insurance on the sales customers that are in their book that they sell to.
So with this one being a very well-known brand of Saks Fifth Avenue, do you think this is something like, how does that factor into the factoring arrangement with them thinking about recourse versus non-recourse, do you think?
So it can be more difficult to qualify for non-recourse factoring, as the lender will likely require your sales customer to have a strong credit history, well-established timely payment history. In Marie's case, currently, Saks Fifth Avenue could be considered difficult to qualify for non-recourse factoring, as this sales customer's credit is currently viewed by lenders with caution. Marie may also not have many other sales customers in her portfolio that she sells to, which would, if she has more sales customer, it would dilute the risk for a factor.
Mhm.
But in this case, we don't know, because we just know she's selling to Saks Fifth Avenue for fall. If a business is only looking to use AR factoring for sales related to a single sales customer or a few sales customers, many times recourse factoring facilities are a better fit and is what will be offered by the factoring lender because of concentration issues, meaning Saks Fifth Avenue may be a $500,000 sale, but she may have A, B, and C stores that only have $25,000 sales. So the concentration risk of Saks Fifth Avenue is greater than the ABC stores.
Got it.
And the big thing, what Jennifer just pointed out, and concentrations is a big issue. Factors, when they look to give money out, they usually set up advance rates. And the advance rates are usually based on the strength of the client, but also the tracking of the history of sales of disputes. So usually factors use a formula. It's called double dilution. So if, let's say, the normal dilution is 10%, the factor will advance 80%. That's called double dilution. And therefore, that's where it enters into. So when Jennifer mentions concentration issues, that will bring down usually the advance rate as well, because the factor wants to have a cushion just in case the customer doesn't pay back.
And when she's deciding to enter into this arrangement with respect to the accounts, would she have to inform the customers? So inform Saks or some of the other customers that she's using for that?
So the definition there is two types, just like we say there's recourse and non-recourse. The two types of factoring is notification and non-notification. On a notification basis, yes, you have to notify the customer that you've sold the receivable and the money should be gone payable directly to the factor. In a non-notification factoring, you don't, and it's the arrangement is between the factor and the seller, and the customer might not know that there's a factor in place. I will caution anybody who goes into a non-notification basis, the factors are going to be more selective on how they're going to deal with somebody, because factors want to make sure the monies are coming to them directly.
And so in these, how do you deal with, especially, for the apparel industry or other industries where you're selling, widgets of sort, how do you deal with like chargebacks that might happen?
So the chargeback is a whole area in itself. So I'm going to take a few minutes out just to describe. Once upon a time in the 80s and 90s, that's the 1980s and the 1990s, chargebacks were really what we would call year-end allowances. And many of the retailers would just say at the end of the year, like a token, give me an allowance so I could work with you next year and you could sell me. So at that time, it was a merchandise situation that of value the manufacturer felt, well, I'll give them back a little money so at least I could have the benefit of working with them going forward, and I'll still maintain my basically full gross profit, and it would be called marketing expense, whatever. But in the mid to late 90s, the retailers formed cooperative for themselves to have profit centers where they just charge back properly or improperly. It was their way of taking deductions all year long and at any time indiscriminately. And in some cases, almost they set up a formula called guaranteed profit, where the vendor had to actually guarantee them a gross profit, and therefore it was even in the cards. That is a very important point that has happened over the years, that factors when they look at clients, what type of selling arrangements do you have with your customer base, and how does that dilution work? Because chargebacks have been a problem. So that being said, some factors have come up with different concepts. One concept was chargeback's your problem, it's not mine. I'm not even going to review it. I'm just going to charge it right back to the client and do no collection effort at all. There are third parties that actually collect on chargebacks. Factors might educate their clients to use these third parties. Those third parties usually work on a contingency where they'll get a percentage of what they claw back, and they know what the mechanics are on how to work with the retailers on how to collect on chargebacks. There have been some factors when they have a problem client, have it in their contract, they're permitted to go in and represent their client for chargebacks when the client could be either insolvent or poor credit. I've seen that happen over the years also. But for the most part, chargeback is just a tough world that manufacturers have to really live with, and the factors try to sit outside the problem and the risks and maintain the best exposure that they can so that they're not coupled with that. And that's why it's very important when they set up advance rates, they have a general idea what the dilution runs.
Definitely. That is a lot to think about when it comes to whether or not you go into a factoring arrangement.
So there was a time that happened to me when I was in factoring some decades ago, where Walmart set up with their vendors, where they told their smaller vendors, we don't want to buy from you anymore because we can't charge you back enough that makes it worth our while. So they sought out bigger vendors so they could have bigger chargebacks.
Wow. So now that we, I think, have a good idea as to factoring, sort of the benefits, cons regarding factoring, and all the things to think through. Let's circle back to one of the other options that you mentioned, Jennifer, which was purchase order financing. You know, assuming that Marie was able to get that fall clothing line out, she's now working on a spring line and has received multiple orders, including big purchase orders from Neiman Marcus, Bloomingdale's, and she does not have the funds really to fulfill those orders, despite having other arrangements in place. So Michael, can you talk about purchase order financing and how that might be able to be used for this one as well?
Yeah. In the apparel industry is actually one of the most perfect industries for purchase order financing, because the background is it's unpredictable. I mean, there's a new line, and all of a sudden the orders are 10 times more than expected, from, a Neiman Marcus or a Saks. We're picking on Neiman Marcus and Saks, but that's okay. And that's a good thing and a bad thing. A good thing is more business is great. The bad thing is if our client cannot fulfill those orders, that's not going to be good, and that's going to hurt reputation. So if you're in that industry, I think I'd like to preface by saying, if you have other loan documents like a line of credit or something, a lot of lenders will build in the ability of the borrower to go seek separate purchase order financing. That particular lender may not be in the purchase order financing business. Maybe they are, maybe they're not. So that's exactly what purchase order financing is. I think we should all think of it as like bridge financing. You have a large order. The suppliers want to be paid. They're not going to release the goods. The Neiman Marcuses or the Saxes of the world, they have their 60, 90-day terms. So we see sort of a cash flow problem gap here. And the purchase order financing is sort of the plug for that gap. So the client would, again, it's going to be sort of underwritten by the purchase order financier to see, hey, are these real orders? Are, the whoever made the orders credit worthy? Is the billing system good? And it's a true loan, unlike a factor, which is, as Harvey and Jennifer correctly described, is really sort of a sale of an account receivable. This is a loan. Could be a short-term loan. There could be limits on the loan. So the financier will loan our client money to go out and buy, the dresses, the lines from the supplier in order to have them be purchased and then sold off to the different customers. And it's really it's a great alternative, because what are our clients' other alternative? Raise more money for equity. Well, that gets complicated. Then you're giving away some of your company. Your traditional lender, maybe you may have other assets that are pledged. And purchase orders are not super predictable. I mean, it's great that our client, the spring line or the fall line did great and there's a lot of orders, but it's not predictable. So it's a good problem. And I love the way, in my experience, the purchase order financing, the apparel industry is popular for it. Different equipment industries are very popular too. All of a sudden, a new product is introduced, and it goes viral. It flies off the shelves. People can't get enough. So, um, our client doesn't want to over manufacture and not be able to sell. So that again, I can't say enough. I've had many clients, legal clients over the years, use a lot of different types of purchase order financing, and generally works well.
So I'd like to
Yeah.
jump in here. I know Jennifer is the
Please.
expert on purchase order finance, but I just want to put my 2 cents in. Everything Michael said is correct, and that's focusing on the value of that customer who's buying the goods from you. But many PO firms, and I'll let Jennifer address it, they give the client the benefit of knowing who the good vendors are that they're actually purchasing from. And I know there's a history. And if you have vendors that are not good, that's a problem that the manufacturer is going to have seeking out outsourcing for contractors, whether the country they're in or the specific contractor. So I'm going to let Jennifer handle that because it is part of a service that the PO provider does. And I'll put in a plug for Rosenthal, who is one of the key PO firms in the country. So Jennifer, take it away.
Okay. So there's several advantages to using PO financing. It may cover up to 100% of costs, including landing costs, if the product has a strong margin. It provides faster access to funds to support your purchase transactions. We typically experience a much quicker time frame getting a deal in place, getting a facility up and running for purchase order financing than we can if you're doing a factoring facility or an ABL facility. And as mentioned, PO financing can work with other existing lenders that you have in place now. That's a key component. Because you need an AR takeout because we do not hold the receivables, but we will work with outside lenders all the time. And it builds a great relationship and strong back office support for the business as well. A lot of PO finance clients experience overall improved cash flow. And we're here, PO finance lenders are here to support business growth and scalability as well. As I mentioned, PO financing is typically quicker to obtain than a traditional bank loan and or factoring or ABL. There's no equity dilution with PO financing. You're not asked to bring in equity. We come in and fill the need that you need at that time to get your goods into production, produced, and delivered here stateside. You also, as Harvey so nicely mentioned, PO finance lenders have a lot of experience dealing with suppliers, dealing with freight logistics companies, brokers, warehouses. So by entering into a PO finance facility, you also get the advantage of that PO finance team and their expertise working in this in-transit industry.
So
There are
Jennifer,
disadvantages. A PO financing loan can end up being a higher cost and fees compared to factoring, asset-based lending, or a bank loan. But even though you're looking at higher costs, we're transactional based, so more short term. Higher risk transactions are our specialty, including and our our payments will cover supplier first costs, landed costs, warehousing, and other items like inspection if you're required to have a third-party inspection. Things like that can get covered through the PO financing side, but we will not cover operational costs.
so Jennifer, could you just explain on the PO side how you advance, suppose on gross profit, et cetera, how you set up your rates for that for your borrowers?
Okay, so on the PO finance side, we take an assignment of the sales customer purchase order. So, say you have a $1 million order from Saks Fifth Avenue for an upcoming season. If we set, as the PO finance lender, we set our advance rate at 70% of that sales PO, we will lend up to 700,000 to get the goods into production, get them made, the transit across the ocean here into the States, and deliverable. Then, sorry, I lost my train of thought. So that's the basis for how we look at the sale. We don't lend funds additional other than to cover the costs of the supplier costs and the landed costs. So essentially, if it only costs 500,000 to make that line for that's going to sell for $1 million, we're only going to fund you the 500,000. So it's not a loan per se where you're going to be able to take out the full 700,000. I just wanted to make that clarification. Most PO lenders only will work on specific payments out to get the goods produced and here in the States to be deliverable to the sales customer.
It sounds like
Depending
that's
on a
one of the
product's gross margin, if it's not strong, we might not be able to fund up to 100% of the supplier costs. But in my experience, most of the time we are able to work with our clients and make it happen that we get covered at least enough that everyone's comfortable in the transaction.
So it sounds like that's one of the reasons why many companies may have, in addition to doing purchase order financing, they'll have an ABL or some other financing arrangement in place to sort of balance out the two.
So, Jackie, I think it's important what Jennifer just said and what Michael addressed before. If you go to a lender and that lender doesn't give you the permission to enter into any additional types of specified borrowing, you're shooting yourself in the foot. And that's why it's very important when you go out to know what your best needs are. We're factoring in PO who work together well when they do is a better way than going to a bank where maybe you get your money a little cheaper, but they don't give you the opportunity to get specific financing that you need.
That's a good point. And I know, Jennifer, you had mentioned, certain costs and things that might be involved in doing a PO financing, but generally, like, would you say that PO financing is cheaper, more expensive, or what are the considerations there?
It's more expensive if you look at it on an annual basis, but if you look at the short-term cycle that the transaction's going to be open, plus the fact that you can use PO financing, you don't have to bring in equity, so that's a big plus. During that time frame, if payments start coming in, if cash starts flowing and it gets paid down quicker, then it lessens the amount of fees over time.
So, Michael mentioned something before, which is very important. Many moons ago, PO financing wasn't really a mature financing opportunity. In the garment center apparel, it did start much more earlier than anywhere else. But in the very old days, firms found themselves not having anywhere to go. So they went for some real interim money where people would say, I'll finance your order for you, but I want to have a percentage of your business. And that's what used to happen in the old days before PO financing really entered into play.
Sounds like it is good that it is here now,
Yeah.
because a lot of companies likely lost a good amount of equity.
Yeah. And I would just add, two things for our viewers. As Jennifer described, and that's been my experience in her company, there is still a fair amount of due diligence on the lender side with PO financing. To Jennifer's comments, they're looking who the vendors are, the suppliers. It's, the strength of the purchase order. If you have, large companies, although in the apparel industry, who knows? I mean, even some large companies are in and out of business and out of business. But my experience has been there still is a fair amount of due diligence and quote unquote underwriting by the lender source. So that's to be expected. My second comment is, what lender does what type of loans as far as ABLs, POs, purchase order financing, factoring. As we've seen, each lender has their comfort level and their level of risk that they're willing to accept, and their space in the market. And if you're a novice in these industries and you're borrowing, you're putting together a few layers here. Harvey, Jennifer, and I are talking about it like it's easy this, easy that, but it takes time to understand how to navigate this. I don't think that should be understood. I've dealt with some experienced folks who are just kind of getting into a little bit of a different industry, and there's a little bit of a education process as to what's available and what are the options. So just a couple comments.
So
No, I think
along
that's
those
excellent
lines,
point.
Jennifer and I were speaking before we got on the call, and it is history when a factor and a PO work together well. It's a good way to go because they each know each other's respective appetites, documentations, and everything else. And sometimes if you go with a new lender, so to speak, or a new PO person who you don't know, you got to really work through all the problems that can happen. So it's very good when you have professionals who know what they're doing, you've worked well with them before, you have similar ideas, due diligence concepts, documentations, and it's so much beneficial for the borrower when they could find those players that work together well.
I think that's well said, Harvey. We've talked a lot about the diligence that the lender or the factor will have to do when it comes to determining whether or not they enter into, any arrangement or financing with the company. But it's important for the company to understand that the company needs to do its own due diligence on who it's doing business with, and make sure that the parties they're considering have experience, especially in these situations, with their industry, because a lot of times having a lender or a factor that actually understands your industry can save you a lot of frustration, and then point you to other resources that might also be available. All right, and I know on the slides we have, for those that aren't as familiar with the sort of purchase order financing process, we have slides 40 and 41 through 44 that deal more with all of the things that Jennifer and Harvey and Michael just described regarding the purchase order financing. So let's talk about an additional alternative financing, which, can have its pros and cons. But let's talk about merchant cash advances. So Michael, can you tell us about, who uses them? How do they get repaid generally?
Sure. And I know Harvey will also have a lot to say on this because this is one of his specialties. And I have some experience with merchant cash advances, and I know there's legislation, and I'll sort of set the stage, and I know Harvey will have a lot to say. I think the merchant cash advances is really just what it sounds like. Cash advanced to certain types of business. I think the perfect example is really a restaurant. A lot of credit card purchases no real, collateral for lenders other than, their equipment. And let's assume all that already has a lender. Sort of unpredictable in the amount, is the restaurant going to be busy? Is it not going to be busy? Most, customers are either paying by cash or, the vast majority these days by, credit card. And so the lender basically says to the merchant, hey, I will loan you money, but I need to get a percentage. It's really not an interest rate. A percentage of your sales is going to go directly from your bank. Customers use a credit card, you get the money. That money will be swept from your bank to our bank. So we'll keep the faucet open, we'll keep the cash coming, but you're going to have to pay us X%. And if you think about it, it really works well for industries with a lot of, you know, less expensive, fast sales, quick sales. You need cash because you constantly have to, a restaurant is perfect. You have to buy food, you have to buy drinks, you have to buy supplies. You're just not sure how much, but more cash is available, the higher the sales are. So that's the type of industry. There has been legislation, which I let Harvey talk about, because of there's been some past sort of abuses by the lenders, but that's in essence what it is. It's sort of like factoring, but it's sort of quicker and more volume is the way I like to think of it. And I've had a few clients, they were both restaurants, do this. And it worked pretty well. You get a lot of sales, you need more cash, the cash comes in quickly. It's pretty automated and seamless now. So it's short-term business financing, similar to finance factoring, but at a sort of a more rapid pace.
So I'll jump in on the MCAs. Just to give a little background, in the late 80s and into the 1990s and into the early 2000s, there became an industry called credit card processing, where people used these service providers to handle their credit card receipts. These credit card processors came up with this concept. Well, in addition of me charging you fees for doing this, I'll make money available to you as much as up to 6 times your sales. So previously, if you did $100,000 a month, I will give you up to $600,000 in advance to process your credit card receivables. So this was a concept that happened for about 20, 30 years or whatever, and it was at higher rates. But many people felt, I'll pay a little more, but I'll get the benefit of money I normally wouldn't get, plus I'll have the credit card processing. Around 2008, when the world hit a depression with the way we had some recession type, that changed to be merchant cash advance, and the credit card processing went away, and the merchant cash advance took over. And basically what they did, they didn't call themselves credit card processors. They called themselves ACH swipes. We're just going to swipe money out of your bank accounts. Any money you collect through AR or cash or credit card receipts, whatever it is, I'm taking money out of your bank account under an ACH. And I could take it as much as daily, every couple of days, every week. And as Michael pointed out, it was more on a percentage of how I was going to take, and they didn't want to discuss interest rates. So what happened over the years, in the last, now since it's about 15, 17 years, it's become the wild, wild west in our industry, because these merchant cash advances have made a lot of money because of the rates that they charge, which could be anywhere from 60 to 120%, which in many states is usury. And the question came up, is it a loan or is it a purchase? If it's a purchase, it would not be considered usury, but
Right.
if it's a loan, it is. So that became one big question. And I didn't notice, but most states do have usury laws. There's still some states in America who don't have usury laws, believe it or not. Anyway, that being said, what these MCAs did, in addition to forming a way of giving money at these high interest rates with very liberal credit policies, because they were working on such a high return of investment that they were making, many times they entered into a relationship with somebody who already had a borrower, and they didn't respect the fact that there was a borrower in place. They still went in and took money and did swiping of accounts. They didn't enter into intercreditor agreements. There was no UCCs filed, and they just took money indiscriminately to the extent that an existing lender had a problem because they didn't even know the borrower didn't tell them they took on this MCA type of an account. If you circle back to what we talked about with factoring and ABL and PO financing, it was not in the dark, it was open. The lenders worked together with intercreditor agreements and everybody worked in a kumbaya basis, not so much with the MCAs. In
And so that,
addition to that, sorry, you say something, Jackie?
I was going to say, so that sounds like in addition to not being good for the lender, for the borrower, it likely would get the borrower in trouble.
Correct.
Um,
And many
with
lenders would
rates.
say you're in default if I find out you're using an MCA. So, along these lines, another thing that came up in the last 15 or 17 years along these lines is what is called ISOs, independent selling organizations, brokers. These brokers, for the most part, are animalistic. They're only working on one thought process. The more money I could get the borrower is the more money I can get paid commissions on. So without giving any thought to the financial condition of the borrower, after they were successful enough to get the first MCA done, then they went and they got a second and a third and a fourth and all the way up to 8, 9, 10 MCAs involved. And these MCAs kept giving the money out and working on this, and everybody was grabbing it. Became a problem in today's world called MCA stacking, which is a big problem in today's world. Michael identified before some states have gotten complaints about this, and they're trying to put in all sorts of legislation. Texas just did one successfully. Matter of fact, the SBA, the Small Business Association, just declared a few months ago if anybody is involved with MCAs, they will not allow them to be an SBA borrower.
Oh, wow.
Other states have been involved with this as well. So it's become a big topic of conversation, and the traditional lenders are very upset and with these MCA up, especially on the stacking side. MCAs, to their credit, will put out money to give the borrower an opportunity to succeed, but at what cost? And if you do the value of that arrangement on how much money they're charging, which is excessive, and it's for really a problematic without taking any due diligence on the borrower that he has the ability to pay back, it became a problem. So there are elements today where there are different organizations, I'm involved with some, that are trying to get an MCA stacking solution process. We could identify who these problem accounts are and get them some sort of rehabilitation through refinancing and other elements. It's something that is happening as we speak. That being said, states are looking into this. And the whole concept of a merchant cash advance, it's taking money against future sales. And that's not a purchase. That really buys on a loan against a future transaction. And that's one of the definitions, and I want to be legal about it, that causes where usury can be brought in. So it's a moving target right now. The state of Maryland tried it, didn't get away with it, but they're relooking at it again. California, New York, and New Jersey have set it up, Virginia too. There's a lot of states all looking at it, and we're all going to be focusing on this. Coincidentally, I was mentioning it to Jennifer before and Jacqueline before the call. I got approached yesterday by an attorney who I dealt with about before COVID, who represented an association of MCAs. They actually have their own association. Fortunately for them, they deal with the better MCAs, and they're trying to put in better efforts so that these MCAs do serve a purpose in the market, because they can put money on the street that traditional lenders can't. And if they could be guided accordingly for the benefit of the borrower and the benefit of the traditional lending institutions, they can be valuable. So they reached out to me. I used to do some joint conference with them on one of my associations, the New York Institute of Credit. And we had some good conferences, and we kicked the tires on how they could be good and how they could interact with others. So there are some good MCAs that can be very helpful. The problem is that a smaller bunch of the ones we have to deal with. So that's basically the current events of what's going on with MCAs today.
And I think, Jennifer, you had mentioned that you also heard that Illinois is sort of looking at MCAs and whether or not there should be legislation or regulation there. And I'm sure there are other states, just based on all the things that Harvey has said, that are really sort of looking at this. Jennifer, do you have any thoughts on MCAs?
It's difficult for a lender, PO finance lender, asset-based lender, factoring lender to come into a business where they're using MCAs. Sometimes we find that the MCA lender has filed a UCC. And that would have to get unwound before we could close any type of PO financing, factoring, or asset-based lending facility for the borrower. So it gets messy, it's challenging. There are some ways to work around it, but they take time. And consequently, it just extends out your due diligence process from the time you start to the time you get through and are possibly able to close that deal.
So I will tell you that recently I've been to a few conferences, and a lot of the bankruptcy judges who are friends of mine have asked, can you guys come up with some beneficial ways to handle these MCAs so we don't have to be handling them in court where they're a problem? So that is it's all over it's not just in regular traditional lending, it reaches its way into bankruptcy and turnaround situations as well.
So it sounds like if you're considering doing an MCA, which, as Michael mentioned, it has been used and found to be beneficial. I guess if you have a good MCA lender by restaurants and some bars and things of that nature, then you should definitely make sure that it's not going to cause it to limit, as you was mentioning, Jennifer, your ability to get other arrangements that might be, more beneficial and less costly for you.
Yeah, I would say, as Harvey illustrated with, MCA stacking. I mean, if you have a borrower giving away, 10% of its revenue to 8 different MCA lenders, it's kind of a problem.
Yeah.
And and the borrowers very often in certain industries are not as sophisticated as others, and the allure of kind of the quick money is brought in problems and reforms.
And that's probably stealing some of the cash flow that you could otherwise have, and allow you to put in place another arrangement that is definitely less costly. So,
by the way, Jackie, I've seen it. As I say, there's so many things that have dastardly been done. I've seen some MCAs tell a borrower, I'll give you your money, but I want you to hire this turnaround guy who's going to go in and watch the accounts for me. And therefore, you run up an additional overhead that you really don't need. but it was a condition of getting money.
Yeah. So eyes wide open. It sounds like when it comes to MCAs and stay tuned as there's lots going on in various states regarding that. All right. So I think with that, we've now covered all of the topics that we wanted to cover today in discussing alternative financing, and that concludes our webinar. Thank you, Harvey, Jennifer, and Michael for providing your very, very helpful insights today and spending time with us this afternoon. And I encourage all of our audience to continue watching Financial Poise webinars. And if you have questions, definitely reach out, as I mentioned, to info@financialpoise.com. Thanks, everyone.
Thank you all.
Thank you.